If you hold gold, GLD, or any miners right now, stop what you're doing and watch this. Because something happened this week that the mainstream financial media is completely ignoring. They tried to push gold down. Hard, coordinated, aggressive, classic playbook. And it completely backfired. That candle right there? That is not retail buying. That is institutional accumulation disguised as a sell-off. And I'm going to show you exactly what the data says is coming next. We're going to cover 3 things today. 1. What actually happened in the paper market this week? 2. What the physical market is screaming that nobody is talking about. 3. The exact scenario that plays out from here, and the key levels you need to have marked right now. The data doesn't lie. Let's get into it. Look at COMEX futures. Right here, Wednesday morning, early Asian session. Someone dropped over 40,000 contracts in a 4-minute window. That is not a hedge fund rebalancing. That is not a pension fund de-risking. That is a coordinated paper dump designed to trigger stop losses and shake out weak hands before a major move. And here's the thing. It didn't work. Price dipped, briefly. And then it was bought, aggressively, within the same 15-minute candle. When you see a wick like that get reclaimed that fast, you're not looking at retail FOMO. You're looking at someone who wanted that dip. Someone big, someone patient. Someone who knew exactly where price was going. Now here's where it gets really interesting. While the paper market was being manipulated lower, the physical market told a completely different story. Physical gold premiums at major dealers? Still elevated. Silver? Even more so. Think about what that means. The paper price says one thing. The guy trying to actually buy real metal is paying a completely different price. That spread, that gap between paper and physical, is one of the most important signals in this entire market right now. And historically, when that gap widens during a paper sell-off, it means the physical shortage is real. And it means the paper manipulation has a time limit. We've seen this before. Look at 2011. Look at what happened in March 2020 when the paper price crashed, but you couldn't find a single silver eagle anywhere in the country. The physical market always wins eventually. Now let's talk about what the smart money is actually doing, because it's the opposite of what the headlines say. GLD inflows over the last 30 days? Significant net positive. And the COT report, the commitment of traders, commercial shorts are unwinding. Large speculators are building long positions. That combination, in this macro environment, is one of the most historically reliable setups for a sustained breakout. Layer on top of that the dollar index. Trend is weakening. Real rates are under pressure. Central bank buying, particularly from BRICS nations, is at multi-decade highs. Every single fundamental input is pointing in the same direction. Okay, so here's the scenario as I see it, based purely on the data. We have 3 key levels on the weekly chart. Level 1, immediate resistance. This is the level they've defended twice in the last 6 weeks. A weekly close above this? That triggers the first wave of algorithmic buying. Level 2, up here. This is the big one, all-time high territory. Breakout above this, and you're looking at price discovery mode. No overhead resistance, just open air. Level 3, the floor. If we lose this level on a weekly close, the thesis changes. We reassess, full stop. Right now, we are coiling between level 1 and level 3. And after what happened with that failed dump this week, I believe we are closer to testing level 1 than most people think. Let me show you what this looks like historically. This is the 2005 to 2011 gold bull market. 3 failed dump attempts, elevated physical premiums, COT. Positioning flipping from net short to net long. Sound familiar? From that accumulation zone, gold went from $700 to $1,900. A 271% move in 4 years. I'm not saying we're going to see an identical move. Past performance is not indicative of future results. But the structure, the mechanics, the positioning, it rhymes. Loudly. Here's the wild card that almost nobody is talking about. COMEX registered gold inventories, declining, consistently, for months. When registered inventories get low enough and open interest stays high, you create the conditions for a physical delivery squeeze. Traders holding short paper contracts suddenly can't find the physical metal to deliver against them. That is how short squeezes happen in commodity markets, not from retail Reddit threads, from the fundamental reality of paper promises outnumbering actual metal. We saw a preview of this in silver in early 2021. The retail attempt was messy and ultimately failed, but the underlying stress it exposed in the COMEX system was real. Now imagine that same dynamic, but driven by institutional players and sovereign nations who actually have the firepower to demand delivery. That is the scenario I'm watching for. And the timeline, based on inventory drawdown rates, could be measured in months, not years. Let me give you the concrete levels I'm watching. Bullish scenario, timeline 4 to 8 weeks. Weekly close above level 1. Confirmation with volume. COT continuing to flip. Physical premiums staying elevated. Base case, timeline 6 to 12 weeks. Continued coiling. One more shakeout attempt, possibly deeper. But physical demand absorbs it. Same ultimate target, longer timeline. Bear case, invalidation. Weekly close below level 3 with high volume. COT positioning reversing. Dollar staging a real sustained recovery above key level. Watch those three things. Not the noise, not the headlines, the levels, the positioning, the physical data. So what do you actually do with this information? Number 1, know your levels, mark them, respect them. Number 2, watch the physical premium data at least once a week. That spread between paper and physical is your early warning system. Number 3, position sizing matters more than being right. If you're right about the direction but sized wrong, you won't survive the volatility to see the payoff. Number 4, watch the COT report every Friday. When commercials start covering shorts aggressively, that is your confirmation signal. The manipulation failed this week. The data is aligning. The physical market is sending a clear signal. What happens next depends on whether the paper market can hold back a tide that, based on the evidence, is becoming very difficult to stop. If this analysis was useful, drop a comment below. Tell me what you're watching. Tell me where you think gold goes from here. I read every single comment. And if you're not subscribed yet, you're going to want to be for what's coming next. This video is for educational and entertainment purposes only. Nothing in this video constitutes financial advice, investment advice, or a recommendation to buy or sell any security or commodity. All analysis represents personal opinion based on publicly available data. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance is not indicative of future results.